Okay guys, welcome. So really excited to have you guys here. Session number 3 in the 10x Your Options Trading course from Options Trading IQ. Today we're going to be looking at my two favorite and unique strategies for this market, which is the bearish butterfly and the weekly diagonal spread. So lots to learn today, so make sure you're paying attention. Before we get started, I've got a quick disclaimer because we are going to be looking at actual trades that I've placed in the past. So I just wanted to remind you guys that any information contained in this presentation is for educational purposes only. Neither IQ Financial Services LLC or Gavin McMaster are licensed financial advisors, registered investment advisors or registered broker-dealers. Neither do they provide investment advice, financial advice or make investment recommendations, and they're not in the business of transacting trades. Nothing in this communication constitutes a solicitation, recommendation, promotion, endorsement, or offer to buy or sell by IQ Financial Services LLC or Gavin McMaster of any particular security, transaction, or investment. Any trades and/or results covered in this presentation may or may not be live trades. All trades and trading results are believed to be accurately presented. However, since the trades may not have been executed in the market, the results may have been under or overcompensated for the impact, if any, of certain market factors such as liquidity, slippage, and commissions. Therefore, there can be no guarantee of accuracy or completeness. No representation is being made that any portfolio will or is likely to achieve profits or losses similar to those shown. The risk of loss in trading securities and options in particular can be substantial. Customers must consider all relevant risk factors, including their own personal financial circumstances, before making any financial transaction. Options involve risk and are not suitable for all investors. See the options disclosure document, Characteristics and Risks of Standardized Options, available from www.optionstradingiq.com/risks. Okay, so quick recap on session 2. We looked at the Greeks. So we looked at all the 5 main Greeks there, delta, gamma, vega, theta, and rho, and we really dived into the Greek ratios. So delta, theta ratio, vega, theta ratio, and we talked a lot about delta dollars as well. So, definitely really important stuff that we covered in session 2. If any of it was a little bit confusing, I definitely recommend going back and re-watching that. Some really key concepts there that we're going to be building on. So yeah, Greek ratios, hopefully that opened your eyes a little bit to a different way of managing risk and looking at trading. So that was session 2, and the outline for tonight, we're going to look at the weekly diagonal spread trading plan. So I'm going to share with you the exact trading plan that I use in my trading. Then I'll look at some examples of weekly diagonals, so some past trades, and I'll show you how they worked out. Then same thing for the bearish butterfly. We'll go over the trading plan, again the exact trading plan that I trade off, and then some past examples, including all the adjustments and the scaling in points. And then we'll talk a little bit about the other core strategies and when we can use them, when's the best idea and the best time to use them. Okay. So diagonal spreads, we'll start off with those. This is an example of the payoff graph of the diagonal spread. I think we may have looked at this briefly in session 2. So you can see you've got this big profit tent on the upside and low risk on the downside. On the downside, doesn't matter what the stock does on the downside. This was the Russell. The most we can lose if the Russell pulls back is $200. Got this big profit tent on the upside, but we've also got risk on the upside. So we don't want the Russell to get above this profit tent. It's a zoomed in version, so you can't see the full capital at risk, but on this trade, I think there was about it was either 4,000 or 8,000 at risk. So basically what we're looking for, there's 2 ways that this trade can make money, which is really great. So if the market pulls back really quickly, you can potentially make money quite quickly, just a little bit, maybe a couple of $100, because this is a long vega trade, remember? So market pulls back quickly, you get a little bit of a volatility spike. You might end up getting out for a profit of $100 to $300 maybe. The other way the trade can make money is if it slowly, and I'll emphasize slowly, drifts up into this profit zone. Okay, we don't want it to get there too quickly. If it goes up to 1180, 1190 the next day, the trade's going to be in a loss position. Okay, but if it just grinds up here slowly, and over the course of the week we end up around sort of 1180, 1185, that's going to be really good for the trade. Okay, now it's unlikely that you're going to make, and you can almost discount the top third of this graph. It's very unlikely that you're ever going to make that sort of profit, but you can potentially make $800-900, okay? So diagonal, just pause for a second, guys. Okay, so the diagonal call and put trading plan. So we've looked at the payoff graph, little quick explanation of how the trade works and what we're looking for. So we'll dive into the actual particulars of how I like to trade this strategy. So in terms of objectives, it's a short-term trade and we're looking for small gains of sort of 1 to 3%. So it's a trade that can last from sort of 3 days to 10 days. We want to try and enter for a small credit if possible. Otherwise, a small debit is okay. So what I mean by a credit, sometimes you can actually get into these trades and receive a premium. The example we looked at before, we actually paid $200 to enter the trade, and that's the most we can lose on the downside. Every now and then, you can get into the trade, and this line on the downside might be at $100 or even $200, depending on where you place your strikes and sort of how aggressive you are. So we want that risk on the downside to be very low or potentially even a credit. So on the downside, I wouldn't ever want to risk more than about $200 to $400 would be about the maximum. And if I can, I'll get in for sort of zero or potentially, $100, $200. That way, if the market does drop back, I'm guaranteed a little bit of income on the trade. So, if we're risking, say, $8,000 and we make $200 on the downside over the course of a week, it's not too bad. All right, so trading the following instruments: Russell, SPX, Google, Amazon, TLT. There's all the ones I've used this trading strategy on before. Typically, I'm mostly in the Russell, although I've had some good trades in TLT as well. In terms of capital allocation, this is just sort of a guideline. The way I teach it is with the 6 strategies, we look at a sort of base portfolio value of $100,000, and I'd allocate about $10,000 to weekly diagonals using calls, but I could go up to $15,000 for the puts. The reason for having more capital on the put side is because of volatility skew. Just in order to get the trade to work, you have to potentially place the strikes a little bit further apart because the value of the puts doesn't drop off as much as you go down. And I'll get to strike placement and all that in a second. In terms of a trading style, focusing on weekly diagonals with between 3 and 10 days to expiry, and I like to use the daily and the 30-minute chart for trade entry signals. So what I like to do in terms of entry is the perfect one. I tend to use this a lot more with the calls than the puts. I just have a lot more success with calls, and I just feel a lot more comfortable with it because markets tend to grind up slowly, whereas they tend to crash down. So if you remember, that's not what we're looking for. We've got that profit tent above the market. We want it to grind up, so that's using the calls. If we use puts, we'd have that profit tent below the market, and we'd look for the market to grind down, but sometimes that doesn't really happen. It tends to crash down. So the puts are maybe not quite as good for using this strategy. I tend to use it more on the calls. And what I'm looking for in the charts is an overbought reading on both the daily and the 30-minute time frame. So I'm looking for them to line up. Okay, and when you get that overbought reading, you can potentially see that the market's going to maybe drift a little bit higher, but because we're already really overbought, it's probably not going to go too much higher. So that's exactly what I'm looking for with this strategy, okay? Now, the worst case scenario, always good to know the worst that can happen with the trade, is a rapid move in the direction of the short strike shortly after entering the trade, i.e. within 24 to 36 hours. So with a call spread, if I go back to the previous example, our short strike would have been at 11.90, and in this example, I go out 2 weeks and go out to 12.10. I'll explain that in a minute. So we don't want the market to move up towards 11.90 really quickly. That would be the worst case scenario, okay? The best case scenario would be that the stock moves away from the short strike within a few hours and we can take profits early. Okay, so that's where I'm talking. You can potentially get that $100 or $200 in the space of an hour or two, and I'll show you an example of that. Otherwise, the stock slowly drifts in the direction of our short strike and lands in the profit zone on the Thursday of expiration, or the day before expiration. That's perfect, right? So again, going back to the graph, we're starting at sort of 11.62, 11.63. Let's say this trade had 7 calendar days to expiry. We enter it on a Thursday. By sort of Tuesday or Wednesday next week, if we're up around 1180, that's going to be pretty good for the trade. Okay, so you can make money on the downside if it happens quickly, or you can make money on the upside if it happens slowly. And sometimes, again, if you're entering the trade for a credit, you can make money on the downside no matter what. You can just make a little bit of income. Okay. So continuing on with the trading plan, in terms of entry guidelines, I want to place the short strike around delta 10 to 15. So I'll look for the option chain that's about, roughly 5 to 10 days. I've got there on the trading plan 3 to 10 days to expiry. I tend to be more in that sort of 7 to 10 day range. 3 days is a little bit aggressive. It's a little bit too short term for me. So go out around 10 days, 7 to 10 days, and I put a short strike at around delta 10 to 15, so somewhere around sort of 12 is really good. So I sell that one, and then I go 20 points out for Russell and go 2 weeks out. So if I'm trading, let's say whatever, January 26th, 1340 calls, I'd trade the Feb 10th 1360 calls. Those are the ones I'd be buying. I'm going to go through a few examples so you'll see. Okay, so 20 points apart for the calls, and sometimes, as I said, as high as 40 points apart for the puts because of that volatility skew. So the difference in price from the one that you're selling and the one that you're buying, sometimes you have to go a bit further out for the puts. And as I said, I prefer not to trade the puts with this strategy. It's a little bit more risky. So I tend to be more focused on the calls. Again, enter for a credit if possible. Small debit's okay, a couple of $100, that's fine. And here I was talking about the technicals. Enter when the stock is overbought. So that's when we're doing a call spread or oversold. We're using puts on a 30-minute time frame. So I'm predominantly using the 30-minute time frame. If I see that the Russell, or TLT, Amazon, or whatever, is really, really overbought and has been for a while on that 30-minute time frame, that's the time I'll start looking at this trade. And ideally, I want to match that up, match the 30-minute time frame with the daily time frame. So if the 30-minute time frame is really, really overbought and the daily time frame is really, really overbought, I can be reasonably confident in terms of risk and reward, putting the odds in my favor, reasonably confident that the market's not going to shoot up too much higher because it's already really, really extended. It's either going to just drift a little higher or it's going to pull back. Okay, so that's what I'm looking for. If entering for a debit, keep risk on the defined risk side to less than $400. So if we're doing a call spread, remember that graph on the downside, I don't want that side of the graph to be lower than minus 400. I don't want to pay more than $400 for the trade, okay? And exit guidelines. So whenever you're trading, it's always important to have your exit planned. Getting into the trade is the easy part. You want to have your exits already planned before you make the trade. So if price gets to within 5 points of the short strike, I want to exit it no matter what. So previous example, short strike was at 1190. If we hit 1185, I'm out. Stop loss of 2%. So, if we're risking $4,000, 2% of that is my stop loss. Short-term profit target 1% within a few hours. If I can get out if the market drops and I can take that profit quickly, I'll do that. Otherwise, longer-term profit target is 2 to 3%. So that's on capital at risk. Close on the Thursday afternoon at the latest, so I never take it into settlement on Friday. It's just too risky to take those short options into settlement. If you don't understand how settlement works on the indexes, I've got an article that I could send you, but just basically, they stop trading on the Thursday afternoon. You can't trade those options anymore as of 4:15 or whatever it is. And then the actual settlement price isn't decided until the Friday open, but you can't trade it, so it's kind of out of your hands, and I don't like to be in that situation where I don't know what's going to be happening and my hands are tied, there's nothing I can do. So I like to close it out before settlement and before expiration. I mean, the good thing is with the Russell is that, it's cash settled, so there's no chance of being assigned on the stock or anything like that. If you're trading a stock, you've got to be a little bit careful of that. You don't want your the short strike to be in the money because you could potentially get assigned. And with the other guidelines anyway, you'd be closing out before that point. Okay, so some examples just to emphasize what I'm talking about here. So going back to 2014, I think this one was, February 20th, Russell was quite overbought. This was actually the payoff diagram that we looked at earlier. So we're at 1162. So I go out, Feb 20th was the date. So I went out 7 days and I sold the 1190 calls. Okay, so I sold 4 of those. Then I went out 2 weeks, so March 13, and I'm buying the 1210 calls. Okay, so 20 points apart, 2 weeks apart. I sell the front month and I buy the back month. Okay. Now the way Interactive Brokers shows this is that I'm buying this diagonal spread. So I'm buying 4 contracts for $70. So the maximum risk is $280 on the downside. Okay. Capital at risk, 4 contracts, 20 points apart. So it's going to be $8,000 at risk. So just below that 10,000 that I was talking about. Okay, a couple of days later, and I'll show you on the graph, Russell has drifted up to around, I think about 11, got quite close to 1190. It was up around 1185. Closed it out 1 day before expiry, selling the 4 contracts for $1.85. Okay, so we bought the diagonal spread for 70, we've sold it for 185, so we're making a profit. Okay, this was the initial Greeks. So again, Greeks and Greek ratios are quite important. I haven't put any rules into the trading plan, but basically if we look at this, starting trade delta theta ratio is 10%, so really, really good. Vega theta ratio is 1:1, really good. Again, we've got positive Vega, so that helps offset some of the negative Vega that we might have in the rest of our portfolio. So really nice looking beginning position. It's a shorter term trade, so gamma is maybe, it's not overly high, it's only 2, but we're short gamma, so we've got a little bit of price risk. But generally this is a really good looking set of Greeks to start this trade. Our delta dollar exposure is 8,000. We've got $8,000 capital at risk in the trade as well. So, that's perfectly in line. I'm quite happy with that. In terms of rules, maybe don't want to let delta dollars get above, maybe 30,000 or something like that. Maybe even a little bit less, but somewhere around there. Okay, so again, this was our profit graph. So this was the one from the earlier slide, just the same one again. Maximum risk on the downside is about the $200. 8,000 at risk on the upside. We're looking for a little rise up into here, and just looking at the trades, we opened it for 70, we sold it for 185, so we've made $1.15 times 4 contracts, so we've made a bit over $400 on the trade. So divided by 8,000 is around 5%, so not a bad trade for a couple of days. So looking at the graph, this was the entry and the exit point. So really interesting trade to learn from this one. So, we'd had this period on the 30-minute time frame where we'd been quite overbought, quick pullback, and then straight back into this overbought reading. So at this point I'm thinking, yeah, we might drift a little bit higher, but shouldn't go too much higher. So entered here towards the end of the day on the 20th, more or less flat the next day, and then a big bump up the next day. Okay, so we've gone from 1160 up to 1180, and remember our short strike was at 1190. So at this point the trade was in a little bit of a loss position. Hadn't hit 1185, which was the point where I wanted to get out. Hadn't hit my my stop loss in terms of the loss position of the trade. I think it was still maybe down a little bit at this point because we'd had some nice time decay. There's only a few days left in the trade. Get a really nice pullback here. Trade was looking pretty good here, but then again the next day, really big bump up, and we've got up to around 1185, really overbought, and I wanted to get out of the trade because I was worried that it might continue up and breach that 1190. So closed it out just here on the second orange candle where the red arrow is. Made a nice profit. If I had have held on for another 30 minutes, we got this pretty sharp drop off, and the trade would have actually made a little bit more profit. But I just thought the risk wasn't worth it, given that it was getting so close to the short strike. Okay, so next example, Feb 28th. So this is an example of a really quick trade. We've entered at 10 o'clock in the morning and we're out by 3 o'clock. So in this case, again, we've done a call spread, but the market has dropped within a few hours of us placing the trade. So Russell at time trading at 11.93. We've gone out March 6th, so entry on Feb 28th, we've gone out roughly a week or so, 12.10. Now it's a little bit more aggressive with this trade because the Russell had been really, it had a really strong rally. So you can see the difference in the trade. Look at the delta dollars is a lot higher. Delta theta ratio is still around 20%, so still okay. It's not too bad. But certainly this was a little bit more of an aggressive trade. I was a little bit more confident that the Russell wasn't going to rally too much more. So we've gone out roughly a week, sold the 12.10 call. We go out another 2 weeks to March 20th, and we go out 20 points, and we're buying the 12.30. Okay, so we do that 5 times. Cost us roughly 40 cents. So I'm trading an extra contract here because the price of the spread was lower. So 5 times 40, that's $200. That's my maximum risk, again, on the downside. Now we'll look at the chart in a second, but a few hours later, Russell has pulled back. We've got a little bit of a volatility spike and exited the trade for 80 cents. So we've made 40 cents on the trade times 5 contracts, a couple of $100 in a few hours. So I'm happy with that, right? Okay, so this was our starting graph. So you can see similar but a little bit different to the previous one, a little bit more aggressive in that the vertical line here is a bit further up into the profit zone. The previous example would have been a bit further back. But as I said, I was quite confident that the Russell wasn't going to rally too much more. So looking for a really quick pullback or a very slow grind up to this sort of 1% higher mark. As it turned out, we got a quite sharp pullback, closed out the trade a couple of hours later. Okay, so this is where I closed the other trade that we were looking at before, Feb 26th. A couple of days later, Russell is still overbought on the 30-minute time frame. Haven't got the daily chart here, but it was also overbought on the daily chart. Also a bit of divergence, so that's a really key technical indicator that I look for, where price is sort of continuing higher or at least making an equal high, but the indicator is making a lower high, so there's divergence there. So the rally, this is just telling me that the strength of the rally is declining. Okay, so I was confident that the Russell wasn't going to rally too much further. Sure enough, we declined, closed out the trade. Now it did continue falling, and I think the next day, if I had have still been in the trade, possibly in a small loss position when it hit the low, and if I had have held on maybe to the end of the next day, would have been looking okay. But then again, huge rally the next day, and then that would have left the trade in trouble. So it was a good thing I exited when I did. If you can get that profit early on in the trade, sometimes it's best to take it. Took out a couple of percent out of the trade. Okay, so bearish butterfly. So that was a couple of examples of the diagonal spread. Now we're going to look at the bearish butterfly. So in terms of objectives, on a monthly basis, we're looking for a 20% profit target using a reasonably small amount of capital. So the risk reward is quite high on this one in terms of not having to put much capital into the trade, but it can achieve a nice return. And I'll only ever trade this on the Russell and the NASDAQ. Again, typically I'm trading on the Russell. And again, one question that comes up from time to time is, is it okay to just trade the Russell for all these different strategies? And the answer is yes. I kind of will have multiple positions on in the Russell. So if you looked at my total portfolio, it might be a little bit confusing. There's lots of different strikes for the same expiry, but I track each position separately. So you can set up these portfolios in Interactive Brokers, and I'll have a separate one for each trade, so I can just monitor each trade individually and then look at the portfolio as a whole. So yes, can absolutely have multiple positions on in the Russell or the SPX, NASDAQ, whatever you're choosing to trade, but I just recommend tracking them all separately and tracking the adjustments separately. In terms of capital allocation, looking at 7,500 for this one, and that's made up of 3 lots of roughly 2,500. So with this one, we're scaling into the position. So we start with a 1/3 position size. If it's a bearish trade, so if the market continues to rally, we're scaling in as the market rallies, roughly in $2,500 lots. In terms of trading style, trading will focus on bearish butterflies with between 50 and 60 days to expiry. So it's a little bit of a longer term trade. And usually with the trade, unless the index makes a big move in the first few days, generally not too much happens for the first week or so, week to 10 days. So it's a pretty low stress trade. It's pretty easy to manage, certainly in those first few days, and definitely if the market's not moving around too much. In terms of entry guidelines, we want to enter the butterfly 20 points below the current price. So if Russell's at 1340, we'd center our butterfly at 1320. We want to have the strikes 40 points apart. So if we're centered at 1320, that would be 1360 and 1280. So it'd be 1280, 1320, 1360, that's our butterfly. And the reference point is the short strike of the butterfly. And our roll points are as follows. And again, this is something you'll probably need to refer back to a couple of times just to get your head around a little bit. So a reference point in that example would be 1320. That's where we place our butterfly. If we hit 1360, we add a second butterfly. If we go up 60 points in total, we add the third butterfly, which is the last one. If we're up 70, we roll. And I'll go through this in more examples. It'll make more sense. But basically what's happening is we're putting a butterfly below the market. If the market continues to rally, we're just going to put in a second and a third butterfly just slightly below where that market has gone to. The idea being that eventually the market will have this sort of 1 to 2% pullback and we'll come back into this butterfly structure that we've created. You'll pick up a nice chunk of time decay and the trade will work well. Okay. The situation where this trade isn't going to do well is where the market just continues to rally and you don't ever get that pullback. So it's a bearish trade. You're lining these butterflies up, slightly below the market each time. If the market never pulls back, then the trade is going to be in a loss position. And I'll share on the next slide, some good times to enter these trades. So in terms of the NASDAQ, these are the trading rules. Again, very similar, but the index value is much higher. So we've got a little bit different reference points and things like that. So we're going to enter 50 points below the current price of the NASDAQ. Our strikes are going to be 100 points apart. Reference point again is the short strike of the butterfly, and then our roll points are the reference point plus 100. We add our second butterfly, plus 150, add the third, and then the roll points as stated there. So again, if our butterfly is centered at whatever 3,000 gets to 3,100, we'll add a second butterfly 50 points below 3,100. Okay. In terms of exit guidelines, so profit target of 1,500. If we can get that, we're doing really, really well. So that's on roughly 7,500 capital at risk. Sometimes it might be a little bit more capital at risk depending on how much the butterflies cost to enter. But that's a really decent profit target. We'll have a reduced profit target of $500 once 21 days to expiry is hit. So I've talked a little bit in the past about butterflies, how they the P&L will move around a lot as you get close to expiry. So if you've got a little bit of profit and there's only 3 weeks to go, it's best to just exit, because otherwise your P&L is going to fluctuate a lot. You could be in a profit position, the market moves against you, and all of a sudden you're in a big loss. So generally don't want to be holding these too close to expiry. And again, that fourth exit point there is we close with 10 days to expiry no matter what. We never take it into the last couple of weeks, okay, or last week and a half. And again, stop loss 1,500. So if that gets hit, we're out of the trade, okay. So in terms of good times and bad times to enter a bearish butterfly, so I mentioned that if the market has these really strong rallies and never pulls back, that's going to be bad for the trade. So if we look at the red arrows here, if we entered a bearish butterfly at the bottom here and the market just rallies straight up, that's going to be bad, okay? So started at about 940 and it's gone all the way up to 1,050. So you would have scaled into all three of the butterflies. and never had the pullback. So not a great situation with the bearish butterfly. And looking at the bottom of that red arrow, we're sort of on an oversold reading. So not a good time to be getting into a bearish trade. We look at that first green arrow, we've got an overbought reading on the daily time frame. So that's a much better time to be getting into the trade. Okay, so first green arrow, we're looking at around 1040. Market sort of drifts a little bit higher and then eventually pulls back. So that's perfect. We've had, you know, a couple of weeks have gone by, we've scaled into the trade and we get this pullback into the center of the butterfly. Absolutely perfect. You know, you've got really nice time decay and the price has come back right to the center of your butterfly structure. You know, perfect situation, right? That's exactly what we're looking for. So again, nice time to enter. A little bit similar to the diagonal in that we want to enter after a nice rally where we've got overbought conditions. You know, potentially momentum is going to drift a little bit higher, allowing us to scale in, and then we get the pullback. So from 1040, our first strike would have been at 1020. Once we hit 1060, we'd add a second one at 1040. So we'd have butterflies at 1020 and 1040. Then we get this pullback to about 1030, right into the middle of the structure. About 3 weeks has passed. You know, that's perfect. That's exactly what you're looking for. Again, second green arrow, overbought reading on some of our indicators. Market rallies up a little bit. We scale in. We get a pullback. Perfect. You know, 2-3 weeks has passed and we get the pullback to the center of the structure. You know, absolutely perfect. You know, same with the rest of these green arrows. So you're entering on an overbought reading. Market drifts a little bit higher, pulls back. Now it's also okay to enter here. You know, when we're at sort of 11.25 and the market pulls straight back, you can get out within a week and you can make a little bit of profit. That's also something that I've done in the past, and that's totally fine. You never actually scale in, so your risk is a little bit less. Your profits are a little bit less as well, but that's fine. So not a problem there. But really what we're looking for is to sort of drift up a little bit, scale in, and then pull back. So again here, on the 1, 2, 3, 4, 5th green arrow, if we got in here, market drifts up, we'd probably scale in once here, get a pullback. Maybe we could exit for a profit here if we end up staying in the trade. We'd probably scale into the third butterfly here and then we get the pullback. So absolutely perfect. Again, you know, 2-3 weeks have gone past, come back to the center of the butterfly. So you can see that with the green arrows, really good times to enter. The red arrows, not such a good time to enter, okay? And even if you're a little bit early, you know, on this, towards the end of the chart here, if you get in at 11.50, when we get all the way up to 12.10, you know, the trade's going to be under a little bit of pressure here, but eventually you do get that pullback. So, you know, the losses I've had is when I've entered too early and the market's just continued to rally and hasn't pulled back and my stop loss has been hit and I've had to close it out. Usually, you know, the market will pull back eventually, but it's a question of, you know, can you hold on for long enough? You know, particularly if you're getting close to expiry, you know, that 21-day reduced profit target or the closing 10 days to expiry no matter what. You know, if those conditions get hit, it really is best to just close it out because if the trade continues to move against you and you're fully scaled in, the losses can start to build up pretty quickly, especially if you're getting close to expiry, okay? Personally for me, you know, I like to get into trades where I scale into the second butterfly and then get the pullback. If I'm scaling into the third butterfly, I always start to get a little bit nervous because you've got, you know, a full position allocation, you've got 7,500 at risk, and if the market continues to move away from your butterfly structure, you know, I just get a little bit concerned in that scenario. So the best scenario for me is if I scale into that second butterfly and then get the pullback, okay? So let's look at some examples. So this is an example of entering a trade, we don't scale in, and on the red arrow we get the pullback, we close it out. Roughly 10 trading days has passed, about 2 weeks, so we've got a little bit of time decay and we've pulled back into the structure of the butterfly, so perfect. So entry point here on the green arrow, you know, we've been overbought for, you know, a good few days. You know, potentially the market could continue higher and then pull back, but what happened is we went sideways and then pulled back. So again, totally fine. So this was on the NASDAQ, looking at the examples here. So I was talking in earlier sessions about taking screenshots of everything. So this is from sort of my trading log where I'll write some comments on the trade, what I'm doing. I'll take a screenshot of the trade that I've placed and a screenshot of the Greeks when I start. and I'll make comments as I go, as I adjust. Obviously no adjustments with this trade, but you'll see what I mean in a minute. So on October 24th, we're trading at 33.64. So I go, roughly 50 points below. So 33.25. It wasn't perfect. I wanted to keep to kind of nice quarter point strikes. So it was a little bit less than 50 points below, but that's okay. Entered the trade this morning, bearish butterfly on NASDAQ. With the trade, I'm looking for NDX to slowly pull back towards 33.25, which is what happened. If NDX rises to 34.25, I'll add a second butterfly at 33.75. So, reference point plus 100. So our reference point here is the middle of the butterfly. If we hit 34.25, it's our first add point. Reference point plus 100, and we enter the butterfly 50 points below where it's trading at the time. Okay, the idea with the trade, again, being we scale into the position and wait for NASDAQ to pull back into the butterfly structure. So entered the trade, we bought one for 21.25. Looking at our initial Greeks, they're all fine. Delta's pretty low. Our Greek ratios are going to be a lot different to trapdoors and condors because it's a little bit more of a directional trade. And this is our initial structure. So this is where the horizontal line where the market's trading at the time. We've centered our butterfly just below, looking for that just little pullback, or if the market rallies up to the edge of our butterfly at 34.25, we add a second one at 33.75. Okay, so a few days later, November 7th, so however many days that is, 10 days, 2 weeks, NASDAQ has pulled back right to the short strike, so it makes sense to take profits here. So ended up pulling only about $400 out of the trade, but it wasn't too bad for something that didn't have much risk. Only cost $2,100, and I've made a $400 profit in a couple of weeks. So I'm happy with that. Pulled right back 33.25. Our Greeks are still looking really good. Realistically, I could have kept the trade open if I wanted to, but I was right at the center of the butterfly. Didn't want to look a gift horse in the mouth and closed it out. So this was the structure when we closed. Again, we've pulled right back to the center of the butterfly, so absolutely perfect. So again, looking at the graph, green arrow is the entry, red arrow is the exit. Now, if I had have held on, NASDAQ would have continued higher, and I would have been scaling in and getting really close to expiry, and we don't really get much of a pullback. So that would have been a bad situation if I had have stayed in the trade. Okay. Alrighty, next example. So this time on the Russell. So this is a perfect example. This is exactly what I'm looking for. We enter, we scale in the first time, we get a pullback. So green is the entry, second one is the adjustment where we add the second butterfly, then we get the pullback. So first entry point, we're overbought. We've been overbought for a little while. We haven't had much of a decent pullback. So we're at about 1180. So the first butterfly would have been at 1160. We hit 1200, so I add the second butterfly, and then we get the pullback. Okay. So I started the trade June 18th. Opened a bearish butterfly. I think the market will head slightly higher, allowing me to scale in and then wait for a pullback. So first add point is 1200. Okay, so we're trading Russell this time. The index is at 1180, so we go 20 points below to 1160, and we're 40 points wide. Okay, so 1120, 1160, 1200, and we're going out, roughly 2 months, just under 2 months. So again, sort of that 50 to 60 day time frame is exactly what we're looking for. So we've got 2 contracts. We bought the butterflies for 715, so risking about 1,500. So I could have gone in with bigger position size, but went in a little bit smaller in this case. Again, pretty standard looking Greeks for what we're trading here. So that's our initial position. Again, similar payoff graph. We've got the profit tent just below where the stock is trading. Okay, so about 2 weeks later, July 1st, we've hit 1200. You can see there on price. So we're adding a second butterfly at 20 points below. So it's a little bit late in getting the screenshot. The price had continued up to 1208, but when we hit 1200, I entered the butterfly at 1800. Again, it's cost us about $760, so $760 with a couple of contracts, about 1500. So we've got about 3,000 at risk in the trade at this point. So again, from the journal, I'll always take a before adjustment shot. So this is our Greeks before the adjustment point. Delta dollars negative 20,000. So this is before. So we've drifted outside our butterfly zone, and this is after. So we've added that second butterfly. So you can see here it's a flat shape now. We've got two butterflies. So this will be the left point at the top will be 1160, and the right point is 1180. And our delta dollars has increased here. So as we're scaling in, the risk is increasing a little bit. This is where I'm talking about, once you start getting into the third butterfly, I start to get a little bit nervous, okay, because you really want that pullback. So here we've increased our delta dollars. We're really looking for that pullback, but we've increased our profit potential quite significantly. So we're up to 9,000. Again, you're never going to hit this maximum because you're not going to hold it to expiry. But previously we're at sort of 6,500. Now we've got 9,000 profit potential. If we get this 1, 2, 3% pullback anywhere into this zone, it's going to be looking really good, okay? So July 8th, another week goes past. The bearish butterfly has worked perfectly and I'm taking profits here. I've got here also my fills weren't the best, so probably cost myself a few $100s here. So that's something to be aware of with butterflies as well. Because you're trading 3 separate strikes, the bid-ask spread can sometimes be a little bit higher than what you'd be used to for trading just a regular vertical spread. Okay, so sometimes the fills can be a little bit hard to get in at the midpoint. You might have to give a little bit to the market makers. And that's particularly true when the index gets quite volatile. That bid-ask spread blows out a little bit. So if you do get a sharp pullback, sometimes it can be really hard to get filled at the midpoint and you have to give 10, 15 cents or whatever per contract to the market makers, which is a little bit annoying, but that's, cost of doing business. So total P&L was 925. We had 3,000 at risk in the trade. So in terms of percentage gain, really nice, almost up around 30%. Again, these were the closing trades, so we closed out the 1160 butterfly for $9 and we closed out the 1180 butterfly for $10.45. Remember, we got into both of them at about $7.50, trading at around 1168 at the time. So when we first opened the trade, we were at 1180, we went up to 1208, we pulled back to 1168, so perfect, okay? Now remember, our butterflies are centered at 1160 and 1180, so to come into 1170 is perfectly in the middle of our butterfly structure, so exactly what we want. The other thing to notice with butterflies is that even though we're right in the middle of the structure, we've still got negative delta, so that's just kind of the way things work because of the skew. And realistically, being right in the center of the trade, I could have potentially held on to the trade a bit longer, but my profit target had been hit in terms of percentage. I was trading a little bit smaller position size, which is unfortunate. If I had been trading the full position size, would have easily had the 1,500 profit per the trading plan. Okay, so those are the Greeks at expiry, and this is where the index was traded. So we rallied right up, and then we've pulled back right to the center. So perfect example. This is exactly what we're looking for. And you'll find with markets, they're never going to go straight up, or they do occasionally, but usually they're going to go up in this sort of stair-step fashion. They'll have a rally, 1 to 2% pullback, rally, 1 to 2% pullback, and that's exactly what we're looking for. You get in, market continues to rally a little bit, you scale, you get that 1, 2% pullback. So that's perfect. Okay, so again, really, really good setup. Entry, scaled in, pullback. Okay, so that's exactly what we're looking for. All right, another example. So I guess the next question that naturally comes up is, can you do this trade when the market drops? So, what if you put on the trade and the market just falls really quickly? Can you scale in on the downside? And the answer is yes. So I've got an example here. So open the trade March 18th, entering a bearish butterfly and Russell. I've got here keeping position size very small due to the Fed announcement on Wednesday. So again, being aware of what's happening in the market. Around that time there was a lot of QE and all this sort of stuff. The Fed was having a really big impact on the market whenever they had a meeting. So in this example, kept my position size a little bit smaller just as a bit of a risk management thing. So we're trading at 1200. So reference point is 1180, 20 points below the current price, which means our first add point is if Russell hits 1220. If that happens, we enter a second butterfly centered at 1200. Here are the trade details. I had to put my price slightly above the midpoint of 620 in order to get filled. So again, with the butterflies, 620 was obviously the midpoint at the time, and I couldn't get filled at 620, 625, 630. I had to put it all the way up to 635 to get filled. So it's a bit of a pain. The other thing you could do is you could potentially enter it as two vertical spreads. But again, you're probably going to end up, in about the same position anyway. Okay, so you notice smaller position size, our Greeks are a lot lower, but generally pretty standard looking Greeks for what we're looking for on this trade. So we've entered here on the first green arrow. We were pretty overbought at the time, and we've kind of shot straight down. We've had a little bit of a rally here, counter trend rally, but we've shot down quite significantly over the course of a couple of weeks. So we've hit the lower end of the butterfly here on around April 8th. You can see that second green arrow. So we've scaled in on the downside and added a second butterfly. Continued down, and we've hit another adjustment point, and we've scaled into a third butterfly, and then another green arrow. I think I might have had to roll the top butterfly down because we just continued falling. And I'll show you the trades, but basically if I hadn't made this adjustment, I would have made a really, really nice profit, but I followed the rule and kind of hit a new adjustment point and rolled down, which you'll see, and then we got this sort of counter trend rally, put us back into the center of the butterfly structure. Okay, so an example of a bearish butterfly on a decline. Starting position, pretty standard. Scaling into the second butterfly, so we've dropped. So we started at 1180. Can't see it here, but if we go back here, the lower strike of our butterfly is 1140. So similar to on the upside, when we hit the top of this butterfly structure, that's our add point. This is our add point on the downside. Okay. So we've hit 1140, and we're going to add a butterfly at 1160. So instead of being below the market, we're above the market this time. Okay, so the exact opposite of what we're doing if the market rallies. So I bought this butterfly for centered at 1160, cost 980. This is our Greeks before the adjustment. So you can see here we're down below, price is down below the butterfly, so we've got positive delta now. So I guess it's turned from a bearish butterfly into a bullish butterfly. Again, Greeks are still pretty low though, so the exposure is not huge. So this is what's happened. We've moved from above the butterfly, we've gone all the way down to below, we've passed that lower strike, and we scale in. Okay, so now, interestingly enough, on the downside, our Greeks haven't changed too much by adding this in. But we've got that sort of flat structure now, we've got increased profit potential. We've brought our structure closer to where the market is. We're looking for a bit of a rally. If we continue lower and hit this, the outer wing of the second butterfly, we'll scale into the third one. So April 11th, the Russell's continued down by another 20 odd points. We've hit 1120, so we've hit the outside of this butterfly, adding the third butterfly. So Russell's hit 1120, so I'm adding the third butterfly. This is a bullish butterfly now and is well positioned if Russell bounces back up to 1140, 1150. Okay, so you're really looking for the counter trend move on this, so either way you're trading it. Typically, if you get that pullback early in the trade, I close it out, but on this example I did scale in on the downside, so it's fine to do either, whatever you feel comfortable with. So we've hit 1120. Our butterflies are centered at 1160, 1180, so we really need the market to rally back up, but what we're going to do is we're going to add a third butterfly at 1140. Look at our Greeks, our delta dollar exposure is starting to get a bit bigger. We're positive delta dollars, meaning we want the market to rally from here. We've got very low theta, okay, because we're outside the structure, okay, so that's why we don't have very much theta. So before adjustment, that was our graph. We've hit that outer wing, so we're going to add another butterfly. It brings the structure back a little bit closer to where the market's trading. It's actually dropped our delta a little bit by doing that, and our theta has increased because we've moved the structure a bit closer. So that's been handy. Okay, so that's what our new structure looks like. So that's a fully scaled in bearish butterfly, but we're just on the downside this time instead of the upside. So we've got butterfly at 1140, one at 1160, one at 1180. Ideally what we're looking for here is for the market to rally back up to 1150, 1160. But that didn't happen. So the market continued down another 20 points again. So we've hit 1100, April 15th. We've still got a month to go to expiry, so we're okay. We haven't hit our 21-day mark or our 10-day mark. And I've got here with the Russell now down at 1100. Our initial butterfly centered at 1180 isn't doing as much good, and we're getting too far out of our profit zone. As such, I'm closing it and rolling it down to 1120, which gives us a much better looking graph and also helps out the Greeks. We're primed for a bounce here at 1100, so a nice round number. So again, using a bit of technical analysis and a bit of market opinion. And we're also right at the 200-day exponential moving average, but I wanted to adjust just in case we saw more downside. So if I didn't adjust and the market continued down, I'd be looking at some losses on the trade. As it was, I did adjust and we bounced. So the profit that I made on the trade was much less than if I hadn't adjusted. But you know, I stuck to the trading plan and I'm comfortable with the decision I made, and I'd probably do the same thing again given the choice. Okay. So we're trading at 1100. We've got butterflies at 1180, 1160, 1140. So what we do, we take off the 1180 and we move it down to 1120. Again, you're probably going to have to refer back to this because it takes a little bit of time for this stuff to sink in, right? So don't worry if it's a bit confusing. So in terms of the actual trades, we've sold one at 1180. We've bought a new butterfly at 1120. So we sold one for $6. Because we're moving it down closer to the market, it's going to cost us more. It's going to cost us $9.50. So the adjustment cost us $350, okay, to do that. Greeks before the adjustment, again, that theta is really low because we're outside our structure. Delta's at 21, delta dollars is 23,000. There's our graph beforehand. So again, we're outside the zone, so not what we're really looking for. And if the market continued lower, it would be quite bad for the trade. So we moved the 1180 down to the 1120. So now we've got butterflies centered 1120, 1140, 1160. We're looking for that pullback to roughly 1140, which is now the center of the graph rather than 1160. So our delta has changed. So we've got less directional risk if the market drops, and our theta has increased because our structure is closer to the market now. Okay, so April 16th, a couple of days later, the pullback, or the rally, I guess, has been perfect for our May butterfly trade. So I'm taking the opportunity to take profits while we have them. P&L on the trade is 710 on 2,930 capital at risk for a gain of 24%. Now, I mentioned if I hadn't made that last adjustment, because what happened, the market rallied back up to 1130. If I hadn't made the adjustment, I think from memory, the profits would have been around $2,000, which have been, you know, getting up on close to 100%. But, you know, as I've been saying, high return, high risk. So if the market hadn't rallied, you know, I could have had some pretty big losses in percentage terms, even though I'm only trading a small percentage capital at risk of my allocable allowance. So again, happy with the decision. Profits could have been higher, but, you know, I could have also had a big loss. So I've still ended up with a 20% gain. So very happy with that. These are the closing trades. And this was our Greeks before adjusting. So you can see we've come back almost to the center of the structure, which is centered at 1140. Price is at 1130, so very close, and we're very much neutral at this point. So potentially I could have held on to the trade. In terms of the Greeks, there wasn't really much risk there. We were right in the middle of the structure, but I took profits given that we were you know, above that 20% mark that I'm looking for. So that's where the index ended up, right in the middle of our structure. And again, the graph from the course of the trade. So entry, adjustment number 1, adjustment number 2, adjustment number 3, which was the roll down, and then exit. Now, you know, I could have potentially, looking at the graph, held on another 1, 2, 3, 4, 5, 6 or 7 days, maybe another even 2 weeks, and we would have still been right in the middle of the structure. Would have been quite significant profits. But that's not really what I'm looking for. We could have also had big losses if we had, you know, shot straight down. So happy to stick to the rules and had the 20% gain, so I was happy to close it out. Okay, so that was the bearish butterfly. So we're getting up on the hour mark. We've gone over the two strategies in pretty good detail today. So obviously don't have time to go through the other ones. But in terms of the 6 core strategies, so when do we use them? So bearish butterfly should be pretty obvious now when the market's overbought, but could possibly drift a little higher before pulling back. Weekly diagonal spreads, same as above. And I should add there when the 30-minute time frame and the daily time frame are both overbought. Now the other ones that we haven't really looked at in much detail is the iron condor. So we want to enter those after a period of range expansion when volatility is high. So again, after a period of expansion comes a period of contraction. That's where iron condors are going to do pretty well. And the iron trapdoor, same as above. And then the trapdoor can almost be used as a pretty standard monthly trade. It's a really good one that moves a lot slower than a condor and I've had a lot of success with. Long strangles is one of the other core strategies that we're looking at. So after a period of range contraction when volatility is low. So again, period of contraction, if that is around for an extended period, following that is going to be a period of expansion. So that's when we want to be looking at long strangles. And also the wheel trade. So that's really a year-round trade. And we're using that sort of with the long-term portion of our capital. And we want to enter that after a sell-off when volatility is high. We get those juicy option premiums. And we are also doing it on stocks where we collect a decent dividend as well. Okay, so that's when to use our 6 core strategies. Right, and now on to the next session. So it'll be our last session, session 4 on Thursday. So we're going to look at 5 reasons why you aren't successful or why beginners aren't successful. And we're going to talk about 10 simple steps to becoming a successful trader. And I've also got a big announcement for you guys and also a VIP offer for you guys. You're obviously, really keen on this stuff. I appreciate you taking the time to join these sessions and all the questions. So I've got a special offer for you guys if you turn up to the next webinar. So very exciting times on Thursday. All right, so thanks very much, guys. That was session 3, and I hope to see you all for session 4 on Thursday.